The United States is facing a staggering national debt of $37 trillion, a number so large it's difficult to comprehend. For context, this amount is greater than the entire global economy produced in a single year just 2 decades ago. It's more than the GDP of every country in the world combined, including the largest economies like China and Japan. Yet this debt continues to grow every year, and most Americans aren't even aware of the full scale of the problem. What makes this situation even more alarming is that the U.S. government isn't planning on simply paying off this debt through traditional means like increasing taxes or cutting spending. Instead, there's a hidden strategy underway to erase this colossal debt, quietly and without most people even realizing it. This strategy is not through bankruptcy or default. It's being done through the devaluation of the dollar and the revaluation of 2 assets, gold and crypto, particularly Bitcoin. While the idea of using gold for financial strategies is nothing new, the addition of cryptocurrencies such as Bitcoin into this plan marks a new era in how governments may manipulate financial markets to tackle unsustainable debt. In this video, we will dive deep into how the U.S. government is leveraging Bitcoin and gold to reduce the value of the national debt, how this process works, and what it means for you, the average citizen. To understand the current strategy, we need to take a step back in history. Governments around the world have faced similar debt crises, and many have resorted to drastic measures to reduce their financial burdens. Historically, when a nation's debt became unmanageable, one of the most common tools used was currency devaluation. In the early 1930s, during the Great Depression, the U.S. was in a similar predicament. The government was drowning in debt and the economy was in free fall. In response, President Franklin D. Roosevelt implemented Executive Order 6102, which made it illegal for American citizens to own gold. The government then collected gold from citizens at a fixed price and revalued it, essentially creating massive amounts of new money out of thin air. This devaluation of the dollar helped reduce the real burden of the government's debt by effectively making the debt cheaper to pay off. Fast forward to the present, and the U.S. is using a similar strategy, but this time with gold and digital assets like Bitcoin. While the tools may be different, the goal remains the same: to reduce the real debt burden without directly defaulting or openly admitting to a fiscal collapse. The government's decision to use these assets is not an accident. It's a calculated move to quietly transfer the financial burden from the government to citizens. The key mechanism here is the revaluation of these assets, particularly Bitcoin, and the devaluation of the dollar.
A monetary reset is essentially the redefinition of a country's currency and assets. Governments can devalue their national currency by changing the rules about what it's worth. Instead of directly printing more money, which would result in noticeable inflation and a collapse of public confidence, a government can choose to revalue certain assets that are held on its balance sheet. For example, in the case of gold, the U.S. government holds vast reserves of this precious metal. However, the price at which gold is valued on their books is much lower than its market value. The same applies to Bitcoin, which has grown in prominence as a digital asset. The government could revalue these assets in a way that makes their debt appear much more manageable. This process doesn't require the U.S. to print more money, which would cause hyperinflation, nor does it require drastic cuts to government programs or services. Instead, it uses the value of already existing assets, like Bitcoin and gold, to reduce the apparent debt burden. The idea is to inflate the value of these assets while simultaneously deflating the dollar, making the national debt easier to manage in real terms. The idea of a monetary reset has happened before in history and is now making a comeback in the form of digital assets like Bitcoin, which are being viewed as a modern-day equivalent of gold. Gold has long been seen as a hedge against inflation and a store of value. For centuries, it has been used by governments as a way to back their currency and ensure economic stability. The U.S. holds one of the largest gold reserves in the world, and although the gold standard was abandoned in 1971, the country still relies heavily on gold as a key asset for financial security. The U.S. government's gold reserves are officially valued at a fraction of their actual market value. This is an important detail. For example, the U.S. Treasury values its gold reserves at around $400 per ounce. However, in reality, gold is worth around $2,000 per ounce on the open market. This disparity between official valuations and market prices presents a golden opportunity, no pun intended, for the government to make its balance sheet appear stronger without raising taxes or slashing spending. By revaluing gold to its market price, or even higher, the U.S. government could immediately create trillions of dollars in value on its books. This value could then be used to offset the government's massive debt, reducing the debt-to-GDP ratio dramatically. As we will discuss later, this is precisely the mechanism the government used in 1933 during the Great Depression. Roosevelt's decision to revalue gold was a key factor in reducing the country's debt burden and reviving the economy. A similar strategy could be employed today with gold and Bitcoin, reducing the real cost of the national debt while ensuring the continued dominance of the U.S. dollar in global trade. While gold remains the cornerstone of global reserves, cryptocurrencies, particularly Bitcoin, have rapidly gained prominence as an alternative store of value. The U.S. government
has recognized the growing influence of digital currencies, and in 2025, President Trump signed an executive order creating a strategic Bitcoin reserve. At first glance, this may seem like a positive move to embrace digital assets. The narrative surrounding the executive order is that the U.S. is positioning itself as a leader in digital assets, particularly Bitcoin. However, the true motivation behind this move is far more complex and rooted in the government's need to combat its ballooning debt. Bitcoin, like gold, is seen as a hedge against inflation. The difference is that Bitcoin operates outside the traditional financial system and is not subject to the same level of government control. This makes it an attractive asset for the U.S. government to acquire and hold as part of a strategic reserve. But why Bitcoin? The answer lies in its scarcity and its increasing recognition as digital gold. The fixed supply of Bitcoin, only 21 million will ever exist, makes it an ideal candidate for a new reserve asset. Unlike fiat currencies, which can be printed at will, Bitcoin's supply is fixed, making it an excellent store of value. The government's goal is not just to hold Bitcoin at its current price. It plans to acquire Bitcoin quietly over the next few years, at much lower prices than its future market value, to avoid raising suspicion. Once the U.S. has accumulated enough Bitcoin, it can revalue the asset at a much higher price, similar to how Roosevelt revalued gold. By revaluing Bitcoin, the government can offset a portion of its massive debt without directly printing more dollars. As Bitcoin's value increases, the value of the dollar will decrease in relative terms, allowing the government to reduce its debt without going through the politically damaging process of raising taxes or cutting services. In January 2025, the United States took a bold step forward in the digital asset space when President Donald Trump signed an executive order establishing a strategic Bitcoin reserve. On the surface, this move may seem like a strategic attempt to solidify the U.S. as a global leader in digital assets, securing Bitcoin as a future financial asset. To the average observer, it's a positive step towards the future of money. But when we peel back the layers and examine the specifics, we see that this executive order has a deeper purpose, one that is directly tied to the massive $37 trillion debt that is looming over the U.S. economy. The executive order includes language that grants the U.S. Treasury Department the authority to acquire and hold Bitcoin as a strategic asset. This is not just about encouraging innovation in the crypto space, but rather setting up a mechanism that will allow the U.S. government to quietly accumulate Bitcoin over time without drawing too much attention to it. The order also outlines a framework for the management of Bitcoin, similar to how the U.S. manages its strategic petroleum reserves and gold reserves. This establishes the groundwork for the government to hold Bitcoin as a sovereign asset, to be used strategically and to increase in value over time.
The goal is simple: to acquire Bitcoin at its current, relatively low prices before the inevitable revaluation occurs, and to use this revaluation as a tool to help reduce the national debt. This isn't a one-time event. This is the beginning of a long-term strategy. The government intends to build a massive position in Bitcoin while it remains relatively undervalued in the market. By doing so, they can position themselves to take advantage of a future price surge, a surge they will trigger through official declarations and strategic revaluations. But there's more to the plan. Bitcoin's limited supply and growing demand in the financial and investment sectors make it a perfect candidate for such a strategy. While gold has served this role for centuries, Bitcoin, with its decentralized nature and limited supply, is now being viewed as a more modern and adaptable replacement. The government sees an opportunity to make Bitcoin a cornerstone of its economic stability plan and to use it as leverage against the existing debt. Now that we understand the purpose behind the strategic Bitcoin reserve, let's dive into how the U.S. will actually acquire Bitcoin without causing market disruption. The government is not going to go out and announce that it plans to purchase billions of dollars worth of Bitcoin. This would spike the price of Bitcoin dramatically, making it far more expensive for the government to acquire the asset and drawing unnecessary attention. Instead, the U.S. government will quietly accumulate Bitcoin through indirect means over the next several years. One of the most significant ways they will do this is through seizures. The U.S. government already holds significant amounts of Bitcoin that it has seized from criminal enterprises, including from the infamous Silk Road marketplace and various ransomware cases. The government has amassed hundreds of thousands of Bitcoin through these channels, and they plan to use those holdings as the foundation for their strategic reserve. But it's not just about seizures. The government is also looking at accepting Bitcoin as payment for fines, taxes, and penalties. In recent years, the IRS and other federal agencies have started to treat cryptocurrencies like Bitcoin as property, meaning that they can be taxed, tracked, and eventually seized in the same way that physical assets are. With this infrastructure already in place, the government can use its legal authority to acquire Bitcoin from those who break the law, while simultaneously building up its reserves. Finally, the U.S. could also consider mining Bitcoin through government-owned infrastructure. While this may sound unconventional, the U.S. government controls massive amounts of energy resources through its ownership of hydroelectric dams, nuclear plants, and other energy assets. If the government were to mine Bitcoin using these resources, it could acquire Bitcoin at near-zero costs, further increasing its reserves without having to buy Bitcoin on the open market. This quiet accumulation strategy is critical because it allows the U.S. to acquire vast amounts of Bitcoin without triggering a massive rally in the price, keeping it undervalued and giving the government a larger reserve to work with when it's time to revalue the asset. To fully grasp the magnitude of what's happening with Bitcoin, we must take a step back and look at historical precedents, particularly the actions of the U.S. government in 1933.
Depression, the U.S. was drowning in debt, and the economy was in freefall. At that time, the government was under immense pressure to find a solution that would not only stabilize the economy, but also reduce the national debt. In response, President Franklin D. Roosevelt took a radical step. He signed Executive Order 6102, which made it illegal for American citizens to own gold. People were required to turn in their gold to the Federal Reserve at a fixed price of $20.67 per ounce. Anyone found holding gold after the deadline was subject to severe penalties, including fines and prison sentences. Most Americans complied with the order, trading in their gold for paper currency. But the government wasn't done yet. Once it had gathered a significant amount of the nation's gold, the government revalued the gold, raising its price to $35 per ounce, an immediate 69% increase in value. This revaluation had two significant effects. It wiped out a large portion of the U.S. debt. By devaluing the dollar relative to gold, the government effectively reduced the real value of its debt. The debt stayed the same nominally, but it was worth far less in terms of purchasing power. It transferred wealth from the American people to the government. Citizens who had turned in their gold at $20.67 per ounce lost out when the price skyrocketed to $35 per ounce. This is the blueprint the U.S. government is using today. Just as the government revalued gold in 1933 to reduce its debt burden, it's now looking to revalue Bitcoin and gold as a way to reduce the real burden of the U.S. debt. The revaluation of Bitcoin and gold is the key mechanism that will allow the U.S. government to erase its $37 trillion debt without openly defaulting or raising taxes. Here's how it works. Let's say that the government acquires 1 million Bitcoin over the next few years at a price of $100,000 per Bitcoin. This would cost the U.S. about $100 billion. But when the government announces that it will revalue Bitcoin for official accounting purposes, it could set the official value of Bitcoin at $1 million per coin. What happens then? The U.S. Bitcoin reserves would now be worth $1 trillion, despite the government only spending $100 billion to acquire it. It's a massive windfall that reduces the real value of the debt without any need for cuts to government spending or raising taxes. Similarly, gold can be revalued. The U.S. holds 8,133 tons of gold, but it is currently valued on the government's books at an outdated and low price of about $400 per ounce. If the government were to revalue gold to $20,000 per ounce, its gold reserves would instantly jump to $5.2 trillion, up from just over $700 billion at the current market price. Combined with the revaluation of Bitcoin, the U.S. could have $6.2 trillion in new assets to use against the debt. This revaluation would make the U.S. appear solvent on paper, even though the debt hasn't technically been paid off. It has just been made cheaper to manage.
The key takeaway here is that the U.S. doesn't need to pay off its debt in the traditional sense. Instead, by revaluing Bitcoin and gold, it can reduce the real burden of the debt without causing a massive economic crisis or devaluation of the dollar. While the government's debt burden may decrease with the revaluation of Bitcoin and gold, the real cost of this strategy will be felt by the American public. The revaluation of these assets will lead to a massive devaluation of the dollar. When Bitcoin's value is redefined and the market follows suit, the dollar will lose significant purchasing power. If Bitcoin goes from $100,000 to $1 million per coin, the value of the dollar will fall by 90% relative to Bitcoin. This means that the money in your savings accounts, your bonds, and your pensions will be worth far less in real terms. The same thing will happen with gold. As the price of gold rises, the dollar's purchasing power relative to gold will fall. If gold goes from $2,800 per ounce to $20,000, the dollar will lose 85% of its value relative to gold. This means everything you buy, groceries, gas, rent, and housing, will become significantly more expensive. For those who are holding dollars and other fiat currencies, this process will feel like a massive hidden tax. Your wealth will slowly evaporate as the dollar loses value and inflation skyrocket. Meanwhile, those who own assets like gold, Bitcoin, or real estate will see their wealth increase as these assets become more valuable relative to the collapsing dollar. One of the most alarming aspects of the U.S. government's plan to reduce its debt through the revaluation of assets like Bitcoin and gold is the quiet mechanism of wealth transfer. While most people focus on the potential benefits of these strategies for the government, few understand that the true cost of this plan will be borne by ordinary citizens. The government doesn't have to directly tax individuals or businesses to generate the wealth it needs to offset its debt. Instead, it can use the revaluation of Bitcoin and gold to quietly strip away wealth power from the public. This is not some far-off concept. It's happening right now, albeit behind the scenes. When the U.S. government revalues its Bitcoin and gold reserves, it will immediately reduce the real value of the U.S. dollar. The dollar, which has been the world's reserve currency for decades, will no longer hold the same weight it once did. Let's break it down. When the government revalues Bitcoin to $1 million per coin, it will artificially inflate the value of Bitcoin, making it appear much more valuable than it really is. As this revaluation takes place, the US dollar will lose its relative purchasing power. This will be a hidden tax on the American public, as people will see the cost of living skyrocket without any direct action from the government. The impact will be felt in everyday life. Gas prices, food costs, rent, and healthcare will all increase dramatically. The inflationary impact of a collapsing dollar will affect every aspect of the economy, but especially the middle and lower classes who rely most heavily on their cash.
Savings and earnings. Those who have substantial savings in dollars will find their wealth eroded in real terms, unable to keep pace with the skyrocketing cost of goods and services. This transfer of wealth is not a new phenomenon. Historically, governments have used currency devaluation and asset revaluation as a way to manage national debt without incurring the political fallout of openly defaulting or raising taxes. The mechanisms may have changed, but the end result remains the same. Wealth is being transferred from citizens to the government and the financial elite. This is how modern governments stealthily redistribute wealth, making it seem like a natural consequence of inflation or market forces, rather than the result of deliberate policies. For the average American, this can be devastating. The money they've worked hard to save, the pensions they've been relying on, the investments they've made to ensure a secure future, all of these will be devalued as the dollar shrinks in value. The wealth that once seemed secure will be transferred to the government's reserves, which will be used to offset the nation's debt. Now that we've explored how the U.S. government plans to use Bitcoin and gold to erase its debt, it's essential to discuss what you as an individual can do to protect your wealth. The key to surviving in this new economic reality is to diversify your assets and make smart investment choices before the revaluation happens. The first and most important step is to get out of dollars. As the U.S. begins to devalue the dollar, holding on to significant amounts of cash will be a losing proposition. While many people believe that cash is the safest asset, this will no longer be true, as the government manipulates the value of the dollar through its debt erasure strategy. Instead, you should start converting your savings into hard assets, assets that are not tied to the value of the dollar. Gold has always been a safe haven during periods of currency debasement, and in the current climate, it is likely to perform well as its value rises. However, gold is not the only option. Bitcoin is quickly becoming the new store of value, often referred to as digital gold due to its scarcity and decentralized nature. Investing in both gold and Bitcoin is a two-pronged strategy that allows you to protect your wealth against the inflationary effects of the dollar's collapse. While Bitcoin is volatile in the short term, its long-term potential is immense. It is a finite resource, much like gold, and is gaining widespread adoption as a digital store of value. As more countries, businesses, and individuals move toward Bitcoin, its value is likely to continue increasing. Another important consideration is real estate. Historically, property has been one of the best ways to preserve wealth and protect against inflation. While the housing market has shown signs of volatility in recent years, real estate remains a solid investment, especially if you focus on properties that have a strong potential for growth in the future.
Additionally, consider diversifying internationally. By holding assets in other countries, you can shield yourself from the risks associated with the U.S. government's policies. In some cases, investing in foreign stocks, bonds, or even starting a business in another country could provide you with protection against the devaluation of the dollar. To summarize, here are a few key steps you can take to protect your wealth in the face of a monetary reset. Convert savings into hard assets, including gold and Bitcoin. Diversify your investments across multiple asset classes. Invest in real estate to protect against inflation. Consider international diversification to shield yourself from the dollar's collapse. Stay informed about the government's plans and adjust your portfolio accordingly. The key takeaway here is that early action is crucial. The sooner you diversify your assets and move them out of dollars, the better your chances will be to protect your wealth. Understanding what's happening behind the scenes is one thing, But being able to spot the signs of an imminent financial reset is just as important. This reset will not happen overnight. It will unfold gradually, with subtle signs that only the most astute investors will notice. Some of the early warning signs you should look out for include increased government interest in Bitcoin. The U.S. government's focus on Bitcoin and other digital assets is a major clue. As the government continues to build its Bitcoin reserves, the price of Bitcoin will likely begin to rise. Watching the government's actions, like seizures of Bitcoin from criminal enterprises or acceptance of Bitcoin as payment, will give you a sense of when the accumulation phase is transitioning to the revaluation phase.
Signs of inflation. As the government manipulates the value of Bitcoin and gold, inflation will begin to skyrocket. If you start noticing rapid price increases in food, gas, and housing, it's a sign that the dollar is weakening. Interest rate changes. The Federal Reserve will likely begin to manipulate interest rates in response to rising inflation. Rising interest rates are often a precursor to economic instability and a signal that the government is preparing for a financial reset. By watching for these signs, you'll be able to take action before it's too late. Being ahead of the curve can make the difference between maintaining your wealth and losing everything in the upcoming financial chaos. The big question is, when will this all unfold? Based on the government's current actions, it's clear that we're already in the early stages of this plan, and the full implementation could occur within the next 5 to 10 years. Here's a possible timeline of events leading up to the revaluation and debt reduction. 2025. Government starts acquiring Bitcoin through seizures, fines, and other channels. The executive order establishes the legal framework for Bitcoin acquisition, and the government quietly accumulates assets without publicly revealing its holdings. 2026. The revaluation phase begins. The government announces the strategic Bitcoin reserve and starts positioning itself to revalue Bitcoin and gold. Expect the first signs of currency manipulation and inflation. 2027. The crisis phase. As inflation reaches unsustainable levels, the government is forced to announce the official revaluation of Bitcoin and gold. This is when the dollar will lose its value, and the government will take advantage of this to reduce the debt burden. 2028 and beyond. By this point, the U.S. will have revalued its gold and Bitcoin reserves, effectively erasing much of its debt. At the same time, the dollar will have lost significant value, causing inflation to surge and prices to skyrocket. In conclusion, the U.S. government is quietly executing one of the most sophisticated debt elimination strategies in history. Through the revaluation of Bitcoin and gold, the government is not just managing its debt, it is transferring wealth from the public to the state. As this strategy unfolds, most people will not even realize what's happening until it's too late. To avoid the financial collapse that's coming, it's crucial to act now. Diversify your assets, convert your savings into hard assets like gold and Bitcoin, and start thinking about long-term strategies to protect your wealth. The signs are already here, and if you wait too long, you could lose everything. Stay informed, stay prepared, and take action before the financial reset is complete.